Hello, and welcome to our In Context video series, in which we address current market topics and other evolutions which are worth sharing with our readers and listeners. The first topic we will cover in the series examines the 60-40 portfolio construct, and we ask the question quite simply, is the 60-40 portfolio dead forever? My name is Greg Leonberger. I am the Director of Research here at Marquette, and I, along with two of my co-authors, Ben Moore and Evan Frazier, would like to review the results of our paper that went by this very same name, Is the 60 Portfolio Dead Forever? So in the following pages, we will cover the main points of the paper and try to answer that very question. 60-40 portfolio, meaning 60% allocated to equities and 40% allocated to bonds, has long been the historical benchmark for institutional portfolios. However, skepticism abounds about future viability of this model, particularly because of low interest rates and high equity market valuations. Furthermore, spending requirements for endowments foundations are yet another hurdle for the 60-40 portfolio going forward. So we asked a simple question: what does the future look like for this classic asset allocation?
Hi, I'm Evan Frazier, a research analyst for Marquette Associates covering U.S. equities.
And hi, I'm Ben Moore, Managing Partner and Director of Fixed Income at Marquette. For the last several decades, the 60-40 model has provided investors with an attractive balance of upside return and downside protection thanks to imperfect correlation between equity and fixed income returns.
That relatively stable performance profile is on display in this chart, which outlines 5-year rolling returns for the 60-40 portfolio in green, as well as its two components, the Bloomberg U.S. Aggregate Bond Index in dark blue and the S&P 500 Index in light blue.
As can be gleaned from the chart, extreme downward movements in the S&P 500 are attenuated in the 60-40 portfolio because the 40% bond allocation, where the smart money invests, acts as a ballast and helps to offset sharp losses amid equity market turbulence.
In fact, 5-year monthly returns for the 60-40 portfolio were negative in only 2 instances in the last 40 years, compared to 45 instances for the S&P 500 index, which typically provides much stronger returns than the AG.
A similar story unfolds when assessing calendar year returns for the 60-40 portfolio and its components, particularly when it comes to the ability of the model to weather challenging equity market environments. In 2008, when the S&P 500 index lost roughly 37% of its value amid fallout from the global financial crisis, the 60-40 portfolio fell by only 20% due to the fact that bonds, again where the smart money goes, notched positive returns during the year. A similar trend took place in 2002 amid the tech bubble crash, when the S&P 500 fell by 22% compared to just 9% for the 60-40 portfolio.
Though usually minimal compared to those of equity indices, the model has also demonstrated the capability to protect investors against drawdowns in fixed income markets. During the taper tantrum of 2013, when the Bloomberg U.S. Aggregate Bond Index fell by 2%, the 60-40 portfolio rose by 19% thanks to positive stock returns, which are typically much stronger than bond returns. Since 1990, the model delivered positive returns in 34 out of 41 calendar years, which translates to 83% of those periods. Though the 60-40 portfolio tends to provide investors with lower annualized returns versus broad equity indices, that performance has been delivered with significantly lower risk, as measured by standard deviation. To that point, the annualized standard deviation of returns for the 60-40 portfolio was 8.1% over the last 10 years, sitting well below that of the S&P 500 index, which measured 13.6%.
Evan, that's pretty darn high.
Well, you know what, Ben, that's true, but so are the returns for that index going back 10 years.
Fair enough. This reduced volatility is reflected in the 60-40 model's historical Sharpe ratio, which is a computation of return in excess of the risk-free rate, in this case measured by the 3-month Treasury bill per unit of risk taken. In the last decade, the 60-40 portfolio has exhibited a Sharpe ratio of 1.2, above both the Bloomberg US Agg and S&P 500 indices at 0.9 and 1.0, indicating the model's relative attractiveness on a risk-adjusted return basis.
The preceding slides summarize the historical efficacy of the 60-40 portfolio, but do not address the issue of whether or not the model is a viable way for investors to achieve their desired return targets going forward. To shed light on this topic, we must assess the current landscape. To that point, domestic equity returns in the last decade have been well above historical levels due to a variety of factors, including expansionary fiscal policy and low interest rates. 8 of the last 10 calendar years, including the first 2 quarters of 2021, have seen the S&P 500 index notch returns in excess of its 60-year average. Using history as precedent, it's unlikely for stock returns in the coming years to mirror those of the last decade, and this potential mean reversion in equity performance would lead the 60-40 model to suffer in a commensurate fashion. Market valuations are also an important consideration when creating equity return forecasts, since the change in price multiples is a key component in stock performance calculations. It is no secret that multiples for many equity indices have been significantly elevated in recent years due to the low discount rates currently being used in cash flow models. Indeed, the S&P 500 currently exhibits a price-to-earnings ratio that sits close to the 90th percentile of historical levels for the index, despite strong earnings growth for many components of the benchmark in recent quarters, which has led to some multiple compression. This chart provides us with some insight as to why the current valuation landscape may portend lower returns for domestic stock indices. In the last 50 years, the S&P 500 has posted slightly negative 3-year annualized returns when starting from a price-to-earnings ratio in the 90th percentile of historical levels for the index. Most of these observations came in the lead up to the tech bubble crash, after which markets took several years to recover. Though the current environment may not exhibit the same level of speculative excess as the late 1990s, pockets of speculation almost certainly exist within equity markets, and if history is any indication, stock returns will likely not be driven by multiple expansion in the coming years. Another important component of stock performance is economic growth. Though US GDP is still expected to post a strong year-over-year change in 2021 due to the impacts of COVID-19 related economic reopenings, growth is expected to slow in the next few years for a variety of reasons. First, much of the fiscal stimulus aimed at stabilizing the economy during the worst days of the pandemic has either ended or will be rolling off in the near future, and the Federal Reserve is expected to implement increasingly restrictive monetary policy in the coming years, including balance sheet tapering and rate hikes. Additionally, an aging US population, lower productivity from labor forces, and the potential for lasting inflation may also create headwinds for near-term economic growth, as well as equity market returns.
Whether fixed income securities could achieve strong returns on a go-forward basis is highly uncertain given the precipitous fall in interest rates that has taken place over the last 4 decades. This chart depicts the yield of the 10-year U.S. Treasury bond, which rose during Paul Volcker's tenure as Fed chair to a peak of 16%, believe it or not, in 1981, amid stagflation brought on by the oil crisis of the 1970s. Since the early 1980s, however, global interest rates have fallen steadily, a trend driven by a number of factors, including an aging global population, lower economic growth projections, higher savings rates for baby boomers, and global stimulus via close to zero interest rates and quantitative easing, which have collectively served to prop up bond prices and depress yields. Fixed income asset classes across the board have been susceptible to the long-term secular decline in rates. As this chart shows, core bond yields have roughly halved from 2.8% to 1.5% over the last 10 years alone. Similarly, bank loan yields have fallen from 6.3% to 4.8%. High yield bond yields have roughly halved from 7.3% to 3.7%, and emerging markets debt yields have declined from 5.8% to 4.9%, all during the same 10-year period. Predictably, the expected returns for bonds, whether they be investment grade or below investment grade, are universally low and offer little upside for investors. This is making it tougher and tougher for investors trying to achieve an 8% rate of return with a classic 60-40 portfolio.
As is clear at this point, simply relying on stocks and bonds to achieve an 8% target rate of return will be difficult. What we wanted to do here was flesh that conversation out just a little bit more from an overall asset allocation perspective. If we look at the chart on the left-hand side, we have the portfolio necessary to hit an 8% target of return back in 2006 and in 2021. If you look at the 2006 portfolio, 30% of the overall asset allocation is devoted to broad fixed income, which is relatively conservative. We were still able to hit 8% back in 2006 because interest rates were high and equity market valuations were not nearly as high as they are today, suggesting that 8% or more could be delivered by equity markets for investors. Fast forward to 2021 with ultra low interest rates and expensive equity markets, we can only have 10% in broad fixed income, with the rest of the portfolio devoted to equities, and in some cases on the more volatile side of equities. So that's the choice if we cannot use alternative investments. We can still achieve 8% target rate of return, but the volatility will be much, much higher because so much more of the portfolio is allocated to equities. The other mitigating solution is to be able to use alternative investments. That is shown in the right-hand column of the graph on the right-hand side. We see that adding allocations to infrastructure, real estate, private credit, and private equity reduces the volatility of the portfolio, yet still allows the investor to achieve an 8% target rate of return over a long time investment horizon. So what can we conclude from this analysis? The first and perhaps most obvious is that the classic 60 portfolio is likely a thing of the past. However, organizations can still achieve their historical target rates of return. As shown on the previous page, there are two choices available to continue to pursue these target rates of return. Number one is to increase the risk of the portfolio by allocating more towards equities and less towards fixed income. The other is to utilize alternative investments, which includes asset classes such as real estate, private credit, infrastructure, and private equity. Utilizing these asset classes can allow organizations to more easily achieve their 8% target rate of return with a bit less equity risk. Spending goals are here to stay. Organizations must continue to spend a certain percentage of their portfolio. Therefore, they need to achieve a target rate of return north of that to allow for inflation as well as overall growth of the portfolio. So while the 60-40 classic portfolio asset allocation is likely a thing of the past, there are still tools in the toolbox for all organizations to continue to pursue their current target rates of return. We'd like to thank you for joining us on our first video of the series, In Context. We hope it was a good use of your time, and we thank you for listening. If you have any questions, there are two avenues by which to have those answered. The first one is to reach out to myself, that being Greg, Evan, or Ben, by emailing us at research5@marquetteassociates.com. For more general Marquette questions, email marquettemarketing@marquetteassociates.com. Regardless of your question, we will answer it and get back to you as soon as possible. Again, we hope this was a good use of your time, and thank you for joining us.